All right, good afternoon. Welcome back here to Trader Minute. Great to have you aboard. I'm on just a little bit earlier than I had noted, but this will be recorded, for those that missed the beginning, and that'll be posted into the video library here. But want to go out and do a bank earnings recap and analysis here, and I've gone through the earnings reports of Bank of America and J.P. Morgan, Wells Fargo, and Citigroup here that have reported. I haven't really gone through Goldman Sachs all that much, but I don't think there's a whole lot different with it, from what I've seen here so far. And there's some really interesting things, in the reports, and some very interesting implications. We could go out and we could talk about trading revenues. We could talk about credit losses. When it comes to the banks, there are infinite number of data points for the market to look at, to digest, for analysts to talk about. It is kind of overwhelming, right? Looking and analyzing banks can be pretty treacherous, and even some of the most famous bank analysts, well, they've made their career by analyzing the banks correctly, and they've lost their careers by analyzing the banks the same exact way and getting it wrong, right? And so going and looking at the infinite amount of data when it comes to the banks, to me, just doesn't help. It doesn't do anything. It doesn't give me any sort of edge. It doesn't give me any sort of bias, that I want out there, in the market. But understanding the banks and understanding what it takes for the banks, to me, is a big deal into understanding the market itself and bullish and bearish here overall. And, one of the reasons that I've been bullish on the market pretty much since Trader Minute started comes down to the banks and the fact that the banks continue to be very cheap and they continue to be very inexpensive, despite Brexit, despite U.S. elections, despite Russia, trade wars, and all the infinite number of things that have happened. The banks have remained cheap over the years, and they continue to this day to be very cheap. When we go and we look at the metrics on the banks, they are very inexpensive. And that hasn't changed with this earnings report. And we could go out and look at the reactions of these stocks, right? And they've all had a little bit of different reactions. Citigroup reported on Monday, gapped on down, has been going higher since, right? So obviously, somebody knew something. That's why it gapped down, right? It's just one of those where reading too much into the price action on earnings, you hear me say it all the time. It just because a company gaps down doesn't mean it's bad earnings. Just because a company gaps up doesn't mean it's good earnings. And, we saw J.P. Morgan the next day gap down, rally on higher. Now this morning, Bank of America, it gapped up, and it's continued to go up. Was Bank of America's earnings, were they all that much better? Is the story all that different here? Is really kind of what I want to see. Wells Fargo, to me, has continued to be the ugly stepchild of the banking sector here as they try to gain back investor confidence. Bank of America has kind of been that ugly stepchild in the past after, the financial crisis. But one of the big things that I take from this earnings season is investor confidence in Bank of America is changed. It's changed. This whole idea that J.P. Morgan is the best of the best, and if you want banks, you buy J.P. Morgan. The others are just kind of second best, and look, you buy them, they'll go up, but J.P. Morgan's going to go up more. That whole idea, I think, is coming down a lot based on what we see in the earnings reports here this quarter. And I think Bank of America has gone a long way to improving their reputation on Wall Street with investors and that investor confidence here in the market. All of these banks, if the markets go down, they'll go down, right? They're not going to be immune to sell-offs. They're not going to be that way, right? If the market goes up, they will go up. If the market goes up, they are so inexpensive that they will continue to rally. But let's break down a little bit of this, and then I'm going to boil it all down to one thing that matters when it comes to the banks, and I think it's the only thing that matters after the earnings reports here. Here's J.P. Morgan. J.P. Morgan, Q4, they missed on earnings big time, right? This chart shows what their earnings were each quarter relative to Wall Street expectations, and you can see that they blew it. They came in way under expectations. Big miss, right? You say, well, how come the stock's trading higher after a big miss like this? Right? You know, looking at the headline number doesn't always tell something, right? Last quarter, they beat on earnings, and the stock went down. This quarter, they miss on earnings, stock goes up. Revenue came in about what was expected, a very slight beat versus the expected. But one of the things about this quarter is a year ago, the quarter was so awful for these banks that look at how the numbers look relative to last quarter. The numbers look great relative to last quarter, right? So, yes, they might have missed, but they're still really nice compared to the fourth quarter of 2017. So, year-over-year comparison is very favorable. To me, this is one of the reasons why we saw J.P. Morgan, gap down and go higher. It's one of the reasons why we saw Citigroup gap down and go higher. Look at the comparison to fourth quarter 2017 versus fourth quarter 2018, right? The earnings are very different and significantly higher. Here's Citigroup, though. Look at the revenue. They missed on revenue significantly, right? Their comparison isn't as good. In fact, this is pretty ugly. If an Apple were to do this, or an Adobe were to do this, or a Microsoft were to do this, their stock would be down 15 to 20%. And Citigroup did it, small gap down, and rallied afterwards. Here's where Bank of America differs a little bit. Here's their earnings. And while, yes, they look great relative to last year, they've gone from 47 cents up to 70 cents. They blew the expectation as well. They just beat the expectation big time. 63 cents expected, came in at 70. So not only did they beat the comparable from last year, but they beat the expectation this quarter. On a revenue standpoint, the comparable looks really nice. I mean, they really beat that comparable in a big way. They also beat expectations in a big way, even though revenue pretty much same as last quarter. Okay, so when we look at how they did relative to last year and how they did relative to this year's expectations, Bank of America is the cream of the crop of all of these. Bank of America had by far the best just headline numbers that are out there. Here's Wells Fargo. You can see Wells Fargo, they beat on earnings, right? They beat on earnings. Looked really good compared to last year. In fact, almost a 20% increase, right? So not too bad, but then here's their revenue, right? Their revenue, they missed and they tanked, right? I mean, this is a multi-year low in revenue, right? So when we look at just the absolute best picture from the bank so far, it is clearly Bank of America, here. Now, that accounts for some outperformance when it comes to Bank of America. That's what it accounts for, right? But we have seen the banks beat like this before. In fact, a few times last year, they beat expectations like this and they went down. They fell. They were sold. It's not one of those where you can look at and go, well, wait a minute, because it's this, they should, get bought up and vice. You can go back in past history and see earnings reports very comparable, very similar, and the stock have a completely different reaction. To me, it boils down to one thing and one thing only when it comes to the banks. Because they're inexpensive. They're cheap. But what's going to go on going forward? What's going to be the driver going forward? To me, it comes down to absolutely one thing and one thing only. and that is the yield curve. Now, I'm not going to do a whole recap and summary here of the yield curve. We've done that many times. But if you come in and you look at the yield curve, the Fed right now is talking about halting the rise of this front end. That's giving investors confidence. That's giving investors, that's allaying their worries that, that things are going to get worse going forward. That's giving some optimism that banks can actually generate revenue growth going forward. So the market's looking on forward and saying, okay, they're inexpensive, but one of their big problems is they haven't been big revenue growers. Well, if this yield curve stops flattening, now they're in a position to grow revenue. The Fed's halting the front. It's pretty clear. We heard it yesterday in the whole Fed parade. They're not raising rates anytime soon. The Fed is done. They're absolutely done raising rates. Could they change that rhetoric in 6 months? They could. But for now, the Fed's done. If the Fed were to come out and say they're raising rates, something really dramatic would have to have happened economically. But if they do that without something dramatic happening, we're going to be talking about a big drop in the markets. So the front end, it's there. This level that banks borrow at, that's kind of locked. Investors can look at that as, hey, that's locked. We know what it's going to cost for the banks to borrow money. Now, what can they lend it at? Well, they're going to lend on the back end of the curve. So the higher the back end of the curve goes, the better it is for the banks. Down here, we can see the tickers for these longer dated yields. If these yields rise, right? These yields rise, we're going to be talking about the banks being able to generate significantly more revenue and more profit to go with it. If these yields fall, the banks are not going to be able to do that. It's not going to be about the short term anymore. The short terms are pretty much locked. It's going to be about these long-term rates, and they're going to go up and down based on economic expectations. But we could come in and chart them. We could see them day to day, hour by hour, minute by minute. We could come into the 30-year, and here's the 30-year, and it's rallied, right? It's gone back over 3%. This back end has been pushing back on up. Has it recovered anywhere to the same degree as, as what the drop was? No, it hasn't. But bottom line is, if we wake up in the morning and the 30-year Treasury yield is higher, banks are likely going higher that day, and vice versa. I think it will be that simple. I think it will be that easy to spot. And when we look at the banks and the infinite numbers that are out there from the banks, you want to spot and you want to say, now after some of these earnings reactions settle, okay, I'm not talking about starting this minute, but after some of these earnings reactions settle, if 30-year Treasury yield rises, these banks will rise, and they will rise sizably, significantly. And if 30-year Treasury falls, they will drop, and they will drop significantly. Now, we can also take a look at it in terms of the 20-year Treasury, right? Because that also has to, rise. And I show you the 20-year just for a little bit of simplicity here, right? You'll notice it looks very similar to the 30-year, right? In terms of its movement. But if you want an ETF to track, you could take a look at the TLT. You hear me talking about it. This is the 20-year Treasury bond ETF. So bottom line, if the TLT is falling, what's that about the yield? Then the yield is rising. Okay, so this is kind of an inverse, right? If the TLT is falling, the yield is rising. If the TLT is rising, then the yield is falling. So going forward throughout the rest of this quarter, The correlation, which, there is a historic correlation between banks and the TLT, but that correlation is only going to get tighter, in my opinion. It's only going to get, closer knit, a little more day-to-day based than what it has been, because this is what the markets kind of have to look at. You can see this correlation over time, right? It's generally negative, meaning TLT down, banks up, right? But it goes through periods where, you can't, there's no correlation associated there. No real big correlation. If we come down to a weekly and kind of zoom out on this, we can see it's a little more on the negative side, but still we go through strong periods of no correlation between the 20-year and banks. If we go back to monthly, we can see most of the time it's negative, but hey, that's not always the case. My point here is this negative correlation between the banks and the TLT is going to go into a period where it's negative, like what it was back here in 2009, 2010, or 2013, 2014, where TLT up, banks down, TLT down, banks up, and I think that is going to be something that will last for quite some time, for the foreseeable future. Because when you look at the banks, when you look at the bank fundamentals, there's not a whole lot there to really kind of sink your teeth into and say, well, this is different and this is different. We're going to get big growth here, little growth here. You look at where the portfolios are. You look at where, what's going on with the credit losses. You look at what's going on with the balance sheets. And it's just very clear. They're doing well. The banks are healthier today than they have been in a very long time. They are positioned to withstand some economic shock in a way that you could argue they never have been before. And they are in a spot where they just need revenue growth for investors to put higher premiums, higher multiples on them, right? Because the reality is these banks, they're not being traded at high multiples. Bank of America has a price-to-book ratio just over 1. Just over 1. I mean, you compare that to a price-to-book ratio of an Apple or a Microsoft or a Johnson & Johnson or United Healthcare, a Caterpillar, IBM. I mean, its price-to-book is way cheaper. Absolutely way cheaper. And some of that is the fact that we just have not seen any sort of real phenomenal revenue growth within the banks. They have had a multi-year consolidation. And could they break out of this consolidation? They sure could. They sure could. But here you go with the XLF, really kind of topped on out a little bit at the end of last year and pretty much consolidated ever since. But they are in a position now where where if we do see the back end of that curve rise, investors aren't going to be able to buy enough of them. Investors are always going to be looking to buy more banks, always going to be needing to buy more because the revenues continue to improve. And the way the banks are cut right now, the way that their balance sheets are, the way that they are able to turn revenue into margins or revenue into earnings, we're talking about some pretty well-oiled machines from an investor standpoint, and in a way that we just haven't seen in a while. Will the banks still go down if we get economic chaos? You betcha. If the back end of that curve keeps on falling, we can talk about the banks being cheap all we want. It just won't matter. Because, yes, they're cheap, but if they're not going to grow their revenues because of some macroeconomic factors, no, they're going to be in a little bit of trouble. Jamie Dimon, CEO of JP Morgan, came out with some thoughts and some comments here again today at an economic summit. And one of the things that he said this economic recovery has been anemic, referring to the global economic recovery since the financial crisis. It's been an anemic recovery. And when we look at the data, he's absolutely right. It has been an absolutely anemic recovery. If we just come in and look at yields, right, and we come back to where yields were in 2007, the back end of the curve was almost 5%. Today, the back end of the curve, hey, it just popped up over 3%. It's nowhere close. We are not pumping globally at the same type of economic stage that we would expect before a market goes into heavy, substantial recession because it's overheated. The yield curve doesn't suggest any overheating at all when it comes to the economy. In fact, if we want to compare the yield curve, you can look here back in 2011, and the back end of the yield curve was at 4.6%. Today it's at 3%. The back end of the curve has fallen while the economic recovery has happened. Now, is the back end of the curve higher than what it was, here back in 2016? Yeah, you betcha. As the markets really took off in 2016, 2017, as we came out of that revenue recession, we saw the back end lift up a little bit, right? And it's lifted up a little bit, but it hasn't taken flight into anything of historic norm. And it is still pretty darn cheap when it comes to the 30-year Treasury yield. It's very clear. The front end, it's not going up. It'll fluctuate a little, but it's not going to be the Fed pushing that thing up again. If the Fed's staying flat. Back end rises, home run banks, back ends fall, big drop in the banks. If you want to look at how to play that, right, and maybe some different ways to take advantage or to possibly play it, you could take a look at the XLF and play it with the XLF. Give yourself a lot of time and come in here to a kind of a long-dated spread. A very long-dated spread where you come out to something like, into these 30 to 32s, and you can pick these up for 25 cents. A call spread here, the 30-32 call spread, you can pick that up for 25 cents, and if you're right, it's worth $2. That's a huge move. Right, that's a big reward potential. Right, you can make pretty much 10 times on your money if those banks get a big move up. You can do the same thing on the downside. You can set it up for 25 cents to get into something like the 19 to 21 put spread, and pick that up for 25 cents here, where you have $2 of reward potential. So 10 times your money there with those spreads. If you believe that the market has to make a decision, that it either has to crash from here and drop big from here and go into recession from here, or it has to recover and move up big from here, this is one of the best ways to look to take advantage of it, one of the more inexpensive ways to take advantage of it, and one of those ways where you can look and you can say, hey, you know what? If we are seeing economic growth and we see that back end of the curve go up, the bank upward move hasn't even started. Now, I do think there's still some short-term turmoil and some chop and everything that will happen with the banks, right? I think they will have a pullback. I don't think you have to go chase them today. I think they ultimately will have a nice little pullback associated to them, as things progress here in the market. But it is an area and a group that I think for the most part, and looking at the economic data that's out there, looking at everything that's going on, for the most part is one of the best ways to take advantage of market upside as we go forward here in 2019. We talked about this earnings season being a big one, not necessarily for reactions of stocks or for, does the market go up or down, right? But for what these companies have to say. for what they have to talk about, for what they're looking at going forward. And with the banks, when you listen to what the CEOs have talked about and what they've said, yes, they talk about trade war creating some disruption, creating some volatility. But they talk about the Fed being the biggest creator of that. They talk about the Fed basically with some of their balance sheet unwinding, adding to this volatility. They talk about the Fed being a big root cause to this. And we've talked about how, the trade war and the Fed, they were interlaced here for the reasoning of all the drop. We had one Fed member today come out and admit that. Come out and say, hey, this unwinding of the balance sheet, this has caused some of the excess volatility here in the market. And one of the things we have seen from the Fed is that they recognize what's happened, they recognize what is done, and they reverse course. They have absolutely reversed course. They have put their foot down and said, oh, no, we're done. No, we got to pause. Hey, we've done enough. Well, okay, we get it, markets. We've heard the markets, right? You don't often get the Fed coming out and saying, hey, we are listening to the markets. We've heard you, the markets. We're responding to the markets, right? But the Fed has been very good in doing that. And that has calmed a lot of the market fears that, hey, you know what? Maybe the Fed is on the side of the market again, like they have been for so many years. You've heard of the Bernanke put. You've heard of the Yellen put. You've heard of, you've heard all these kind of different terms to kind of speak to the fact that, the Fed's going to bail the markets out on anything. And, the market lost some of that confidence. And during this time, we talked about how the Fed was losing touch with the market reality. And one thing that has happened so far this year is the Fed has really changed their tune in a big way to really echo some of the worries and concerns of the market, and that has calmed some of the market fears that maybe, just maybe, that Fed is on their side. Now the question comes, can the Fed do anything if the market goes into a downturn? Can the Fed really help at this point? Do they have the tools to do it? Of course they do. Do they have the will to use them? Well, that's obviously going to be a big question mark coming here. Okay. All right, so I want to share that here when it came to the banks. We haven't seen a lot of the other sectors report. We've seen UNH report here. We've seen a few companies come out and report guidance or pre-report here. Sherwin-Williams was one of them the other day here, and you can see the gap down here on Sherwin-Williams. It's an interesting one in terms of its implications for something like a Home Depot or a Lowe's, does that mean a little bit more downside, for Home Depots and Lowe's here? I think that's something that has to be, paid attention to. But, in terms of getting the next kind of round and batch of earnings here, let me show you the calendar. But today after the bell, we'll have Alcoa. We'll have CSX, which is a railroad transport. To me, this is always a big one, important one for its implications, economically. Then we start to get into a little bit of tech with Netflix on Thursday afternoon. It's one where we'll get a few more of the truckers here, and then a few more of the banks, Morgan's, American Express is there. And then, we'll get this VF Corp, which is a retail, which is kind of early for retail, but very nice to see. We'll get that. And then Schlumberger, who will report on Friday with that oil services space. I'm very interested to see what they have to say and its implications. But then we have to go into Tuesday to start to get, a bigger chunk of earnings starting to come in, where we get, Wynn Resorts and IBM and J&J and Halliburton and Capital One and Allegheny Technologies, and where we really start to get into the meat. But again, this is going to be a very very long earnings season, an incredibly long earnings season here. About 8 weeks worth of earnings if you don't count this week. Count this week, we're talking about 9. So it's pretty much the entire first quarter is about earnings, and it's, to me, one of the most important aspects out there in terms of the ultimate market direction here. Obviously, what happens with the trade war, and if that escalates a little bit, we'll see the markets pull on back a lot. But if it, if it resolves, if it's de-escalated, or if it just becomes the new normal, the market is cheap enough, inexpensive enough when you look at the banks to say there's significant upside ahead. Thanks for hopping on. Have yourselves a great one. I'll jump back on here in about 5 minutes and talk about the market today and trades and whatnot there. We'll talk to you then. Take care.